Okay.
Okay. 5, 4. Hey guys, this is Billionaire Acquisition Mastermind. I got here Joshua Himan, and he's going to be presenting with us essentially how he evaluates his companies, how to properly do an evaluation of a private business, as those are different than public companies, and they're different as well from bigger to smaller. So, Josh, if you could do a little introduction about yourself.
Yeah, sure. Well, like I said, my name is Josh Hyman, and I've been a financial analyst for about 15 years. And my specialty is really in small and medium business valuation. And I really do specialize in for acquisition and disposition. So I thought I might do a presentation for you guys and help you guys out as you guys are looking for companies.
Great, great, great to hear. Okay, so we can start.
Okay. All right. So the first thing I want to talk to you guys is the difference between modeling science and modeling economics. Okay. In when we're modeling science, we have things that are called laws. Okay. For example, you have the law of gravity. Okay. So if you hold out an object, it'll fall to the floor, basically creating the weight. Right. And so, but in economics, it's all based on theory. Okay. And so what happens is like, so I don't know if we have any engineers here or people who are engineers by training, but essentially,
Hmm.
if I want to build a building, this high, I need to have a base this wide. Okay. And we can use laws to basically come up with that calculation and be accurate. Okay. So when we're building a bridge,
Yeah.
we know if we want to put X amount of weight, we need so much support. Okay.
Hmm.
The problem with economics is that essentially you're building a mathematical model on top of your theory. And if your theory is wrong, your math becomes worthless. So one of the things you're going to see throughout this presentation, I'm always harping about, is make sure you're thinking first and then build your mathematical model. Okay. So there are really three ways to value a small, medium enterprise. That's what this SME stands for here. Okay. The first way and really superior way is intrinsic value. Okay. We're going to talk a lot about that over this little course here. But the number one thing that it does is it helps us understand cash flow. Okay.
Yeah.
Cash flow is how we pay bills, how we pay debt, how we pay back investors. Okay. The second way is a comp database. Okay, this is where basically we get comparables. Okay, and this is okay. All right, and I'll tell you how I use it. There's no cash flow. Okay, so that's a big red flag there. The databases are really weak, and it really depends on what type of business you're looking at, and really the location of where you're looking at the business. Okay. The way I use the comp database in real life is if it's in my favor. Okay. So I work on both sides of the fence, per se.
Yeah.
Okay. So I work with private equity firms and acquisition entrepreneurs. Okay. But I also work with sellers that are trying to value their business and are trying to put it for sale. Okay. So what happens is that if I go in and I get the intrinsic value of a business, I then can go look in the comp database. And if I find that there are some businesses that are pretty close to either the buying or selling price, you better believe that I include that in my memorandum. Okay.
Yeah.
Because all this is doing is giving social validation to my intrinsic value number. Okay. So let's say, for example, I'm on the sales side and I say, yeah, I think our business is worth $2 million. And actually, when I look at the databases, these companies here sold for around 2 million. So we should be pretty much accurate. You see what I'm saying? But if you use this as your sole base, you're going to find out you're going to get in a world of hurt. Okay. The really the third way, and unfortunately is the most predominant way, is people using a rule of thumb or a reference guide. Okay. Now, I have a business reference guy sitting on my desk. Okay. There's no way I'm going to use it to value the company. Okay. But what I do is if there's a broker or some other representative on the other side that I can suspect using the reference guide, I'll go in and read it just so I know what the way that they're thinking. Okay.
Yeah.
So what's interesting is that, again, there's nothing on cash flow, which you're going to find out is pretty much the most important thing. The average business that I look at, okay, and this is going to blow your mind a little bit, has between 300 to 2,000 different prices. Okay.
Yeah.
So just because, you're going to tell me that you got one price from your rule of thumb, it's essentially worthless. Okay. But this is the number one broker method. Okay. This is the number one record that people are always using. They're like, well, I do, 3 times earnings or 4 times EBITDA or whatever. And even on really high level deals, I was recently, I'll just tell you a quick story. I was representing a private equity firm, and they were purchasing a business that was for sale for $11 million. Okay. And that's not exactly pocket change. Okay. For a lot of people. Okay. And I'm talking to the broker, and I'm always at the broker. I'm like, how did you come up with your number, right? Like, how did you come up with the value? He's like, oh, I just went into the reference guide and I took 75% of sales, when he even used the wrong code. But $11 million business, you have to know that the number one thing buyers are concerned about is cash flow, and you didn't even take the time to measure that. There's no wonder why the business is not going to sell.
Correct.
Right. But that's the reason why we need to know that, hey, this is just something that you can use for a quick method, but you shouldn't rely on it to really value a business. Okay.
Right.
So before we get into anything crazy, okay, I want you to just take a step back real quick and realize that to find the intrinsic value of any asset, okay, that has the cash flow, this is the simple formula. Price equals cash flow divided by risk. That's it. That's it. Okay. Now I will give you, let's go here. I did a little nomenclature. Now, intrinsic value, let me just go tell you what that means. Okay. We can value anything this way if it has an income stream or a cash flow. Okay. Yeah. So what do we use this formula for? Okay. We use this formula to value regular stocks, like Amazon or Walmart that you see every day in the market. Okay. And a lot of people don't know this. The bond market is twice as big as the stock market. Okay. How do you guess how we value bonds?
How?
With this formula right here. Okay.
Nice.
We got a coupon rate, and we divide it by the risk equals the value of the bond. Okay. What else do we use this to value? We use this to value real estate. Okay. Net operating income divided by cap rate for all my real estate people out there. Okay. But we for sure use this in business acquisitions. Okay. So I one time was at a analyst conference, and there's like 100 analysts from around the world. And they had given us all like the business to value before we got there. And they asked for volunteers who came up and showed their model. And there was this girl from Central America, and you should have seen her spreadsheet. I mean, it was beautiful. Okay. But she came out with like a stock price of $78. And they said, does anybody have any comments about this? And so nobody says anything. And I kind of raised my hand, and I was like, yeah, your stock price is high because your growth rate assumption is too high. The professor guy who was teaching the class absolutely went nuts and started pointing fingers at all these people and saying, did you see that? Did you see that? And they're like, no. So I came a little superstar that day, and it was fun for me. But it was just because I didn't forget about this formula. Okay, does that make sense? I'm trying to say is you can get into all the nitty gritty of what everybody's gonna say or super LBO analysis. Just go back to this. Always never forget this equation. Okay, so what we call this is really the Gordon growth model. Okay, so we have the nomenclature here. D1 is cash flow at time one, so it means one cash flow period in the future. Okay, then we have the R here is acquired rate of return.
Yeah.
We have G, which is the growth rate. Does anybody here on the call think that they cannot do this equation?
That seems simple enough.
I mean, somebody with a middle school education that should be able to do this equation. And literally, this is what the whole finance world is based upon. This simple formula right here. Okay.
Yeah.
So let's use an example here. Now, this one is D1, $1.59. Now, this $1.59 could be $1.59 dividend. This could be $1.59 million. This could be $1.59 billion. It doesn't make a difference. It's
Right.
just, there's no difference in the scale. Okay. So what we did is we have a rate of return, 10%.
Yeah.
We have a growth rate of 6. We come down here, we do the math, 159.04. We get a price of $39.75. Okay.
Okay.
Okay. Not too complicated, right?
Yeah.
What gets more complicated we're getting into is how do we pick this top part of the formula and how do we choose the bottom part of the formula? That's what PhDs and all this stuff that we do comes in, but I want you to see it on a basic level, okay? So over here is exactly what we calculated, right? So we came down here, we got the 1.59, got the 39.7, right? I want you to look at this other column over here in the multiple, okay? Here we are, we're using the same exact numbers, 159, R10, G6, right?
Yeah.
We come down here to the $1.59 over 0.04, and guess what? Through the magic of algebra, we can flip this point over 4. So if I take 1 over 0.04, we get a 25. Okay? If I take 159 and times it by 25, I get 39.75.
Yeah.
This is how we get the multiple of earnings.
I see.
Okay?
Yeah.
And so because somehow this formula is so complicated that we had to flip it back over to make it a multiple for the people that make errors so that we get that number, okay? So when you have people, when they're talking in the marketplace and you're going, well, this is 2 times SDE or 4 times EBITDA or whatever, you have to remember to go back that this is the model that we're really talking about, which is really when I go back, cash flow divided by risk.
Yeah.
Okay, so I just want to make sure everybody starts off on their footing that it's not the multiple is really coming from the Gordon growth model. Okay, so let's talk about the numerator. Okay, let's talk about business cash flows. Okay, and this is probably the hardest part for people who are trying to get into the acquisition game because it was hard for me really in the beginning as well. Okay, it's because you have all different measures of cash flow. Okay. And people have, depending on their background, talk in these different terms. Okay, so let's just go over these a little bit, right? You have seller's discretionary earnings, which is essentially everything, including add backs and the owner's salary and the whole kit and caboodle. Okay. Some people talk about EBITDA. Obviously, that's super popular. The investment
that's the most common right now.
That's the most common, and you know, and you're going to find out the reason why they did it is because it's the easiest to calculate. Okay, because you have to remember when I'm on the sell side, I want it like as easy as possible for the buyers to read. Okay, I'm not trying to make it more difficult. Does that make sense? Yeah. But the problem is that let me blow your mind for a little bit. Is you have multiple definitions of EBITDA once you're in the industry. Okay, we have EBITDA as defined. In private equity, we use management adjusted EBITDA, and there's also due diligence adjusted EBITDA. So you can see how it's confusing when I always have to specify what EBITDA are you talking about. Okay, and we'll get into these a little bit as we go on. Then you have EBIT, which is basically earnings before interest and taxes without the depreciation and amortization, right? A lot called NOPAT, which means net operating profit after tax. Okay, it's a common one that a lot of analysts like to use, okay? And it has a lot to do when you're looking at these free cash flows down here, okay? We also talk about net income, right? Net income is a very easy one to read, okay? The problem is it before or after tax, okay? Because here's a little tip for you that a lot of people I never understand. If the business is like, let's say, for example, a pass-through entity, right? It's an LLC or an S corp, right? Some people will say, well, we don't need to tax any of these numbers, right? And I go, when you make income, do you pay taxes or you don't pay taxes?
You do.
You pay taxes. You pay taxes when you make money, okay? So you should always have a tax in here, okay? Now, the problem is when some people have the models, they'll just put 40 or whatever. Let me tell you, there's not a corporation in America that pays 40% in taxes, okay?
Mm-hmm.
They may pay 39.6 or something, or they may pay 21. Okay, you have to have a way of accounting for tax. You need to think about it. But don't just say because it's a pass-through LLC or S corp that you shouldn't tax anything. Okay, because it doesn't make logical sense here. You get what I'm saying?
Yeah, Josh, real quick.
Yeah.
As we all know, net income is stated in the profit and loss statement.
Mm-hmm.
And you talk about there's net income before and after tax. How would you know?
Mm-hmm.
What is usually stated in the balance sheet? Is it before or after tax?
Well, these will actually both be in the income statement.
Mm.
Okay, because it'll show you either you've taken out taxes or you haven't taken out taxes.
Okay.
Right.
Yeah.
So if you're looking at a tax return, you usually can see the before tax, and then it'll give you the tax amount. Right. If you look at the income statement and you don't see a line item for tax,
Mm-hmm.
be assumed that it's before tax.
Okay.
Right.
Okay.
Yeah. One of the other things here is that we have other definitions of free cash flow. Okay. Yes, free cash flow as an analyst means is probably the superior out of all of these. Okay. But the problem is you could be talking about operating cash flow, could be talking about free cash flow, could be talking about free cash flow to invested capital. We can talk about free cash flow to equity. And we're going to get into some of these. Okay. But I just wanted to give you the overall picture of all these different cash flows that could possibly be in your numerator. Okay. Now, I know this is kind of hard to see on your guys' screen, and we're going to zoom into some parts, but I just wanted you to see from the broad view here, okay? Because if you look down here, okay, we have some of the cash flows that we're talking about, right? We have net earnings here, right?
Yeah.
Right, and now we're going to flow it down, right? So let me zoom in here, okay? So again, let's take a look at this year over here because I think it's the most interesting. If you're looking at just EBITDA, they would have had, 7,200,000, right? But
Yeah.
look how the numbers change when you go to cash flow, to free cash flow, to free cash flow to equity, to free cash flow to the firm, right?
Mm.
All these numbers are different. When we go to this year, the numbers start to stabilize a little bit. This year, they're way different, right?
Mm-hmm.
So this is the toughest part for people that are new because they're saying which one of these should I use? And essentially, you could use either one of these as long as you're using the correct risk associated with this cash flow. Okay. But again, the goal is we got to figure this. Now, here's the right answer, and here's how I model. I calculate all of these. And you know why I want to calculate all these? Because if I'm in a situation where everybody's using EBITDA, I don't mind using EBITDA as the valuation, but I need to know what the free cash flow is. Does that make sense?
Yeah, that's smart.
Because if all you do is calculate the EBITDA, let's look at it this way. All you do is calculate the EBITDA and you don't calculate any of these other free cash flows, look how you could end up with a big whammy at the end of the year. Does it make sense?
Yeah, essentially use it as a point of reference, right? When you're speaking with different people.
Correct. Exactly. You see what I'm saying? So when you control all of these, then then you're always in a position to talk the same language and be prepared and see some insights that EBITDA or these other cash flow metrics would not have alerted you to. Okay. So let's talk about that more. Okay. And let's see here from our buddy Warren Buffett and Charlie Munger. This video is a little low quality, so you may want to turn it up. Okay.
The one figure we regard as utter nonsense is the so-called EBITDA. I mean, the idea of looking at a figure before the cash requirements and merely staying in the same place, and there usually are. Any business with significant fixed assets almost always has with it a concomitant requirement that major cash be reinvested in order simply to stay in the same place competitively and in terms of unit sales. To look at some figure that is before that is stated before those cash requirements is absolute folly, and it's been misused by lots of people who sell lots of merchandise in recent years. It's not to the credit of the investment banking fraternity that it has learned to speak in terms of EBITDA. The idea of using a measure you know is nonsense and then piling additional reasoning on that false assumption, it's not creditable intellectual performance. And then once everybody is talking in terms of nonsense, why, it gets to be standard.
So what are they trying to say here? Okay, they're trying to say Warren Buffett and Charlie Munger are staunch free cash flow guys, right? I am myself, right? And what they're selling you is that the sell side community, the investment bankers, created EBITDA. It's because we'll see it's easier to calculate. Okay, and again, hey, if everybody's using it, why not use it, right? Everybody says that. So I'm going to rewind it just one more time, because I want everyone to take a new appreciation what they're saying, okay? So they're basically saying when we calculate EBITDA, we're not getting to the free cash flow.
The one figure we regard as utter nonsense is the so-called EBITDA. I mean, the idea of looking at a figure before the cash requirements and merely staying in the same place, and there usually are. Any business with significant fixed assets almost always has with it a concomitant requirement that major cash be reinvested in order simply to stay in the same place competitively and in terms of unit sales. To look at some figure that is before that is stated before those cash requirements is absolute folly, and it's been misused by lots of people who sell lots of merchandise in recent years. It's not to the credit of the investment banking fraternity that it has learned to speak in terms of EBITDA. The idea of using a measure you know is nonsense and then piling additional reasoning on that false assumption, it's not creditable intellectual performance. And then once everybody is talking in terms of nonsense, why, it gets to be standard.
Let's see what Dave.
It's work-life balance. No. The actual structuring of the deal is going to be about. With David asking questions, it'll probably be 4 hours. But if David wasn't here, it'd be 2 hours. 2 hours. No questions. 60 minutes. 60. And that's if I really slow down into slow motion. Because the actual structure of some of the kids are asking for case studies. Oh, God, help me. I think we don't need any fucking case studies. Unencumbered cash flow's got to cover debt service, full stop, period, end of story. That's the whole seminar. Unencumbered cash flow has got to cover debt service, full stop, end of story. Seminar's over. I'm going to say it again. Unencumbered cash flow has got to cover debt service, end of story. There's plenty of money out there for the deal if the numbers work.
Okay, so thank you, Dan. I appreciate, and he's got it. Free cash flow. Did Valentino, did you see what they were trying to say there?
I saw that. Unencumbered cash flow has to cover debt service.
So the question is, okay, go ahead. I'm sorry.
Yeah, no, unencumbered, what do I mean by that?
what do we mean by that? Let's talk about that now. Okay. So here's where, and this is what we'd ask this is, okay, which cash flow are you talking about? Okay.
Right.
Because let's look at this. How do we get our EBITDA number? Okay. We generate our EBITDA number coming from the income statement. Okay. We have cash flow from operations, which is where we're making all of our adjustments that were non-cash.
Right.
Okay. Then we have free cash flow, okay, which is essentially we're taking our cash from operations and we're minusing our property and plant and equipment purchases. Okay. Now, the superior, this is free cash flow to equity, and this is free cash flow, unlevered free cash flow. Okay. This is probably this is the holy grail here. Okay. This is to me the most superior one, but you can see it's the hardest to calculate. Okay, because we have to go back in, you have to make changes in net working capital. We have to make changes in CapEx. And these are things that I'll be happy to go over with sometime, but we would need a while to really dig in and learn. Okay, but if you notice this one here, EBITDA, see how easy that is to calculate?
Yeah.
I mean, that's a lot easier than getting down here. And that's why a lot of people like to use it. And I'm always, like I said, I'm on the sell side. I'm always just showing this number. Hey, if you want to use EBITDA, use EBITDA. But we need to know when we're looking for unlevered free cash flow, we got to get down to these three metrics down here. Okay. Basically, free cash. Free basically means unencumbered. Okay. Now, here's the only problem. Here's the little trick to this. Okay. And here's the main problem. I'm gonna come back to this sheet. Okay. But in small, medium business valuation, okay, just remember price equals return divided by risk, right? I'm going to say it again and again, okay?
Yeah.
If you're a public analyst, okay, a public analyst, which is 99% of all of us, we spend most of our time assessing risk, okay? The bottom part of the equation. You know why we do that? It's because how are public executives compensated? Okay. Mm-hmm. Well, they make, let's say the executive makes $1 million salary. Pretty good. But they get $20 million in stock options. Okay. So let's go back here. If this is a public company, okay, one, if you want to sell your stock to the public, okay, you got to get audited financials. You have to report a cash flow statement. Right? And the incentive of the public company is to show as much money as they possibly can in earnings. Why? So that their stock price goes up, so they get compensated more. Does that make sense?
Yeah.
That's on the public side. The private side, okay, they don't have to report this to anybody except to the IRS. And what's the company focus in a private company? To lower taxes as much as they can. Right? Because nobody's buying shares of stock from them. Does that make sense too? Okay. And so here's a mega tip for you guys out there. Okay. A lot of analysts they spend all their time worrying about the risk. What you need to spend most of your time on is focusing on the return, making sure that you understand how the sales and expenses are running through the company and how much true cash flow is there. Okay. So here are the problems that you had when you're trying to measure the earnings of a private business. Because right here, I just gave you the formula. Okay. But here it goes back into modeling science versus modeling economics, right? How do you know that the accounting was done properly? See, the problem is when we're looking at small businesses, we can't be sure that their QuickBooks printout was printed out like the right way. Does that make sense?
Yeah. And
they have a lot of leeway in terms of GAAP, how they put their financials together. So that creates a little problem. So you have to really, if you're putting garbage in, you're going to get garbage out, right? So if your numbers are off here, your free cash flow number is going to be off, and you're making millions of dollars of decisions based on a formula that you think is correct, but your underlying theory and the underlying numbers that you're using are incorrect. See the danger in there, right?
Yeah.
So let's talk about, I'm going to jump down to C just while I'm on there. What about fixing the balance sheet? Okay, that's a difficult class. I would need to do a class in terms of trying to fix the balance sheet because the income statement is easier to fix, right? We're going to talk about that in a sec. And then the cash flow statement. How often are you getting a cash flow statement from the sellers? I don't know, 10%, 20%, depends how big the business is. The bigger the business you get, the more likely you are to get a cash flow statement. The smaller the business, the least likely you are to get a cash flow statement. In fact, when you get a lot of stuff from brokers, they just might have an income statement. Is that true?
Yeah.
They didn't even bring all this other analysis in there. So you really have two options. You got to get that and you have to build this yourself, okay, which is what I have to do sometimes.
So the cash flow statement is separate from the income statement, right?
Correct, right? So there's three main statements that everybody, and especially in a public company, has. Balance sheet, income statement, and cash flow statement. The only way you can create this cash flow statement is if you have a balance sheet and you have an income statement. Okay, and you need the balance sheet for at least 2 years because you're making adjustments here on the cash flow. You're showing the changes. Okay.
Right.
So when I'm always now, let's talk about actual deal flow. Now, I'm a financial analyst, but I've closed a lot of deals and still do own many businesses myself. Okay. So when I'm working with a seller that I talk to and there's no broker involved, okay, I'm very careful how I massage to get the numbers, right? My strategy is always I like to get to know the guy. I tell him what a great business it is. You know, he sells me whatever, and I'm like, oh, this is awesome. This is awesome. I never bring it up until I feel it's the right moment. And I always go, sir, you know, I think this is really, really awesome. Excited. I'd love to do this. I just would need to see some financials to, you know, make an offer and actually buy the business from you. And at that point, you see, I'm trying to massage it in. If I'm dealing with a broker, okay, the broker's whole job is to get me documents. Okay, so I'll put these guys to work. And I'm like, hey, I need balance sheets, I need income statements, I need everything you can get. Okay, give me the tax returns, give me all this because I want them to work to get me all these things so I can create this and make good estimates. You see what I'm saying?
Yeah.
So it can take you longer when you're working your way in to get the statements from the buyer, but just for us, you know, your goal is to eventually get here so you can analyze the unlevered cash, right? You're trying to get to that free cash so you can be like Warren Buffett said and do like Dan said, right? So let me jump back here. Okay, so one of the things that, like I said, we're spending our time focusing on the return because what happens in small businesses? You got to do your add backs, right? So one-time fees. There may be a rent adjustment. There could be an owner salary adjustment. Owner expenses on the income statement. You know, what are the classics? Auto. Let me tell you a crazy story. I was representing a girl who was buying a home health company. Okay, and the home health company did about $2.5 million in sales a year. Okay, and I think they probably had 60 workers. So it was a good company, right? Do you know what they reported on their income statement? $40,000. Okay, so $2.5 million in sales, and they said they made 40,000. Okay, so the husband, there was two women that were the wife. The one wife owned the business, and I was representing a lady who was the nurse. So it was like two females who were like the bosses, and two guys, her husband and me, who are the analyst. Okay, and her husband's a CPA. Okay, they tried to add back a $60,000 vacation to Dubai. $60,000 vacation to Dubai. They were trying to add back. They wanted almost $425,000 in add backs. I was like, basically, you're committing fraud. I mean, they were renovating their kitchens, and I mean, it was unbelievable, and I couldn't believe the guy was a licensed CPA, right? You know what I'm saying? He just knew he wasn't going to get audited, right? But then he try to add all these add backs. So we have to spend time on really making sure we do these add backs. Now, here's my rule of thumb, okay? So I want you to think about this equation here. If there are a lot of add backs, okay, I may count them, but what am I going to do right here? I'm going to increase the risk. Does that make sense? So if the owner is reporting all of this income to the bottom line and paying the tax on it, my risk goes lower. That's not real money. Okay? Because you remember, I'm measuring the return and then I'm measuring the risk, right? So a good broker or investment banker. So when I'm selling a business, when I'm consulting a business, I will do all this exercise for the buyer because I don't want to hide anything. I want to show them the money, right? So let's take a look at one just so, but the key thing is, like I said, you got to think logical, okay? So here they've got pre-operating income, right? Pre-tax, right? Then they're adding back owner's compensation, okay? I can take that. Taxes, health insurance, 401k, okay, that sounds good. Replace one of the owners at 100K. Well, is that the market rate? Okay. You don't want to just take this number without thinking about that through. You go, oh no, that's too low or that's too high, right? There's also an adjustment here for rent. What does that mean? It means that that this company owns the real estate and they're not showing rent expense to the business. We got to make that adjustment. Does that make sense? And of course, we have contribution, interest, but also look at this depreciation. In this year here, they only depreciated 107,000. This year they depreciated 776,000. You don't think that that's something you need to look into? 66,000 the next year, then all of a sudden it blows up to 700 and 800,000, right? So our goal is we want to do these add backs, but you have to be realistic and really think through, is this an expense that my company is going to take on when I take over this business? Okay. And right here, they're reporting seller's discretionary cash flow, right? So let's talk about some of the number manipulation, because I've seen some of the posts in the Facebook group, and I just wanted to do a couple of things to show you guys, okay? So when we're talking about profit margin, okay? Company A has $1 million in sales, 700,000 expenses, and net income of 300. That's a profit margin of 30%. Am I right, V?
Yeah, you're right. Right on the money.
Okay. Now, I want you to look at company B. Sales $1 million, expenses $1 million, net income 0, profit margin 0. Am I right about that? Okay.
To me, I'd say that business isn't generating anything. It's all eating up the expenses.
You want to buy company A and not company B, right?
Correct.
Yeah. What if I told you they make the same exact cash flow of the owner?
You got to show me then.
All right. I'll show you. All right. Here we go. Okay. And I've seen these many times. Okay. So this business, what it didn't tell you is that the owners, let's just say it's 3 brothers, don't pay themselves in the expenses. They take a draw in dividends.
Oh, okay.
300,000. Okay. Retained earnings is 0. Company B, all they did was the 3 brothers pay themselves in the expenses. Retained earnings is 0. But look at the difference if you're just looking at profit margin.
Yeah, huge difference. And they're getting the same amount of money.
But they made the same amount of money.
Yeah.
Okay. So this is just a simple example of how profit margin can be manipulated. Okay, because I see it all the time, and you guys, I've seen in there, you're doing a good question. How does the owner pay himself? Right? Because you want to know that, but you have to readjust it. If you're just taking the raw number, you can see that it can be off. Right? Now I know maybe some accountant on the line goes, well, in a C corp, you have to pay yourself a certain salary. I've seen it all the time because these companies just don't get audited. Okay. And yeah, if they had a full audit, maybe something should move up to a salary here so that they pay Social Security, tax, and things like that. What I'm going to tell you guys, the people that own businesses, and when you eventually take over the business, you know what, in my opinion, the proper way to solve this is what you should do is, if you work inside the business, okay, you should pay yourself a market-based wage for what you do. So if the CEO makes $100,000, okay, that's what the market rate be. That's what you should put in expenses, and everything else should go to the bottom line.
Yeah.
Okay.
It's an add
because what? Well, let's sort of, but let's take it one step further. Because what you're showing the next buyer is that if he becomes the CEO, if he buys your company CEO, he's going to get this salary as a base. Okay. If I have to hire a general manager to run the company, okay, I've already got that expense out. Because here's the way I think about it. In a business, you should get paid for what you do. Okay. Mm-hmm. Investors who just contributed money should get dividends.
Right.
Okay. So if you report above average salary, you're not helping yourself because you're making your profit margin and your ability to pay dividends, you're making it too low. Okay. But if you're doing the right thing and the person coming in to buy the company goes, okay, I'm going to bring in a general manager at 100,000 that's already accounted for expenses, and you're making a profit margin here of 18%. Does that make sense? Then everybody knows that's the right way to do it, and so this number is not off. Make sense?
Yeah.
All right. So here's another thing, and I've talked to you before, V, about this, and I always think that this is super interesting to finance guys. Okay. So on the left side, we have a company's net income statement, okay? And they have sales of $1 million. They have expenses of $650,000, depreciation of $100,000. We have a net income of $250,000. That's a 25% profit margin, right?
Yeah.
Sales, net income divided by sales, right? Mm-hmm. So that's where we're at, right? Over here, but let's look at the company's actual cash flow. So it's sales of 100,000. They have expenses of 600,000. Oh, but guess what? There was an equipment purchase for $1 million. Yeah. And we needed this equipment purchase to generate these sales and therefore get this net income, right? Mm-hmm. So what's our actual cash flow? 1 million minus 650 minus 1 million is negative cash flow 650,000.
Okay.
So what happens is that, let's take a note, a capital expenditure at $1 million purchase has a 10-year depreciation schedule. So that means what the IRS wants us to do is it wants us to take this $1 million, put it on the balance sheet, and then expense it $100,000 a year because of wear and tear.
Right.
Okay. Mm-hmm. So that wear and tear is picked up only in the net income statement. So if you were looking at this business and you didn't see this, how nice, look like a pretty solid business to buy, right?
Yeah.
But if you don't actually look at the cash flow, you could look up and they have a big old fat minus. So that's pretty much what's happening when we look back here, where you have these big minuses of free cash flow, but you're having a profitable EBITDA and a profitable net earnings up here. Okay.
Yeah.
So when you guys got a financial guy on your team, you got to find one of my main jobs when I'm working for a client is I want to spot these hidden possible cash flow outlays. Okay, because the goal is if you bought this business and you ended up with a negative cash flow, you're not going to be happy, right? Your investors are not going to be happy. Your debt partner is not going to be happy. The goal of a business is to produce cash to pay bills, debt, and a rate of return to investors. And the investor is you. Okay. Right. So this is my biggest. If you don't know true knowledge of accounting, buyer beware. Buyer beware. Okay. So we talked a little bit about the top side equation, and I'm going to show you some more examples later. Okay. But now I want to talk about the bottom side, the denominator side of the equation. Okay. So let's just run through this real quick. Okay. This is kind of the investment horizon. Okay. This is what we call the investment horizon. Okay. So if we have cash, it's low return, low risk. And then we're going to move on to bonds. These are like, AA, AAA corporates. And then we're going to get into single family homes. Okay. And then we're getting into stocks. Okay. Where do we think small business acquisition is? Okay. Where do you think we are? We're way up here in this alternative space. Okay.
Yeah.
So we should be getting a high rate of return because we're taking high risk. Okay.
Right.
So when I'm looking at a business, okay, and we look, and I'm going to show you an example. So let's talk about this because I just put it for the next slide. Let's think about this price risk for a second, how you can manipulate this formula. If the business is for sale for $1 million, okay?
Yeah.
And you see that the cash flow is 100,000, okay? If you just do that little bit of division here and a little algebra, what is the risk rate that's implied? 10%, right?
Yeah.
So you have 100,000 basically divided by 1 million, which equals, so what it's telling me, so here it is, a business is for sale and it's for $1 million. And you go all those add backs and you do all the work, and then you find out the cash flow is 100,000. What is the implied risk rate that they're selling it at? 10%. Okay. Right. Easy math. So then what I do is I go back and I go, well, is 10% risk commensurate to an alternative investment? I would say no, right? Because what is your expected return in the stock market? I don't know, somewhere between 8 and 12. Right?
Yeah.
So if we're investing in a small business and not a liquid business on the stock market, we need a higher rate of return. So that automatically tells me that it's overpriced. Does that make sense?
Yeah.
So before I did a whole big fancy LBO model spreadsheet, okay, and did all the Olympics and did all these things, remember, I'm just trying to figure out what's the cash flow and then what risk is implied. What's the risk? Okay. So now let me get down to how we actually calculate the risk. Okay. Yeah. If you open any textbook in finance, okay, you're going to see this thing called the weighted average cost of capital, the WACC. Okay. All right. And this is essentially, lack of the better word, the entire study of finance. Okay. People go and get degrees and master's degrees. They have PhDs just over the WACC, okay? And what this equation is saying, and I'm just going to say it to you here, you have the cost of debt times the weighted debt times 1 minus the tax rate plus the cost of equity times the weight of equity, okay? Now, I'm just going to briefly go over how you would actually find these things, okay? So the cost of debt, basically you could call up the different loan people. Say how much interest rate are you going to charge me on my loan, right? You could use the company's current debt, right? Basically, how much debt is the company currently using now, and how much is it costing them? Okay, or you can take an industry average. Okay, analysts use all kinds of different things to come up with these numbers. And the funny thing is, your WACC can be different than my WACC. Okay. Now, the cost of equity, okay, is the risk-free rate plus beta times the market risk premium. Okay. When I first was starting out, we didn't have all this YouTube and Facebook stuff. Okay. So we had to go to like formal university or textbooks. If you're into this and you really want to know this really in depth, Professor Demoterin, who's one of the titans in valuation, has his NY course on YouTube for free. Is that not amazing?
Crazy value, guys. Hey, check that one out. Professor Damodaran on his
Yeah,
valuation
Demore,
course.
valuation, NYU. He's the titan. He's written, I don't
Mm.
know, 12, 13 books on valuation, and they're
Ha,
all on my show.
that's a beast.
Okay. And of course it's on free. Okay. But here's what I'm gonna caution you about. Okay. Is that you're gonna be able to show if you don't understand, okay, it goes back to my theory. Okay. If you don't understand what the risk-free rate here is telling you, and should I use a 5-year, a 10-year, a 20-year treasury, 30-year treasury, 20, should I bootstrap a 25-year? If I don't understand beta, levered and unlevered beta, and why do we use the beta, and you don't understand RM, okay, the number one problem I see people do is they grab these things off the internet, which are available, and then they say, oh, here's my cost of equity, okay? And they have no idea what beta and unlevered beta means, okay? So they're plugging the science without understanding the theory. Does that make sense? But again, all you have to do is do a little bit of background, and he goes through this better than I could ever teach him, okay? But this is what I do, okay? In my real practice, I avoid this. Isn't that funny? I avoid this, okay? And because this is what I do. I developed an assessment guide where I think analytically about a business as opposed to a math equation, okay? Because the only time I do these math equations, okay, in my practice in real life, is when I am battling against another valuation professional. So, for example, if I am on the sell side or buy side, and there's another finance guy or CPA or some guy who's got an MBA in finance or something, he's on the other side of the table. You best believe I'm going to pull this out because he may ask where I got my numbers from, and I'm going to show him. Okay, so I have no problem jocking on this if I have to. But when I'm doing valuation, I don't really just want to plug these numbers in, okay, because I want to think before I model. All right, so let me show you. This is just a screenshot of my assessment guide, okay? And I'm kind of actually putting this in app form, so, you know, if you guys are interested, definitely shoot me an email or something, and once it's ready, I can send you the beta or something, okay?
I like that it has the scores. So scores go from what, 1 to 10?
Scores go from 0 to 10.
Okay.
0 to 10, okay? So what I'm doing here is I go, okay, let's just look at a couple of these right here, right? Risk to buyer based on continual earnings. Okay, so if it's a distressed company, I need to put a 0, okay? If it's a stable company, I need to be around the middle. Significantly growing, I need to be higher, okay?
Yeah.
Risk assessed based on company's age. If it's less than 5 years, okay, let's just say it's a year old, it's going to get a pretty low score. 5 to 15 years, 16 plus years, okay? So a company that's been around for a long time gets a higher score than a newer company. Makes sense, right?
Right.
Revenue grows. Earnings trend. Now, some of these questions are somewhat repetitive, but it's making sure that I have thought about this business. Does that make more sense? Because then what happens is after I do all the score, now it pumps out and gives me the risk rate. And I can say that I analytically thought about the number instead of, or you can go on the internet and plug in your beta.
Yeah, it changes it a lot.
You don't know if you don't like again, if you can't give a lecture on beta, don't use beta.
Yeah.
You know what I'm saying?
Guys,
you need
think then model. Take that one from
think
Josh.
model, right? And so this is what I use. Okay. And if I'm using this, is ridiculous. Again, the only time I use this when I'm jocking.
Right.
And guess what? Usually this is pretty close to what I find in this. And if it's off by a lot, then I'm usually not going to take this one. Okay.
So in regard to your score rates, if we could go back to a slide with the score rates, from those assigned score, you know, the 5.0, 6.0, 3, and 4, would you say that's a good deal to move forward with, or that's more on the be aware side?
Well, it's a good question, but it's a tough question, okay? Because it goes. So here's the thing: if there ends up being a high risk rate, remember the denominator.
Yeah.
If the risk ends up going to be higher, what is that going to do to the price? It's going to push it down.
Okay.
Okay.
Yeah.
And am I saying that you shouldn't buy a business that you can't think you can turn around?
Mm-hmm.
I can't make that general statement. It depends on your skills, whether you know the industry, a whole bunch of other things. Okay. Now, if these scores are really high and the risk is actually really low, well, the business is actually going to be worth a lot of money. And so the question then becomes, yeah, it's a good business to buy, but is past performance a guarantee of future performance? It's not, right? So the goal is that you're always trying to match risk and return. Okay, so if the business is risky, you need a higher risk rate. If the business is not risky, it should be a lower risk rate, and then you make your decisions. So unfortunately, I can't give you a, hey, if this score all rates out fives, I should buy the business. No, depends what the price of the business is.
Correct.
If you get a valued business where all these things are five, then I'm going to tell you that's a good deal to buy.
So that's just one of your various ways of, getting an idea of the business, correct?
Correct. It's when I'm looking for the denominator. But remember, I said we need to spend the majority of our time looking at the return. Okay, because this risk rate is important. But I'm telling you right now, if you spend all your time on this and don't find the return, you're going to be wasting your time, a lot of time in private business. Okay.
Right.
So let me go forward and show you a little bit more modeling. Okay, and I'm going to show you my model in action a little bit. Okay. Before I do that, I want you to understand the things that I always model, and it may be a little bit different than what your financial directors do. But I just want to tell you what I do. Okay, so let's first talk about banks. Okay, and V's heard my little lectures on banks. Okay, but getting bank financing is fairly difficult. Okay, because there's some parameters, and I'll discuss them with you. One, a lot of times you got to have the net worth and credit requirement to get the bank financing. Okay, so you want to borrow $1 million from the bank, and if you don't have it, it's going to be tough. I'm not saying possible, because I do want you guys to go for it. Okay, so don't let my view on things. I've just been in the game for a long time, and I just know what I experienced. Okay. The other thing is sometimes there's experience threshold. So the bankers are going to say, for example, your whole life you've been in IT, and now you want to buy an HVAC company. Well, they go, well, what do you know about doing an HVAC company?
Right.
Okay. What do you do? So you're going to have to come out and you got to figure out. Now, as a finance and accounting guy, we have a little bit of a better chance, because I tell them, well, I run the numbers of the company and I know how to do management, and that's basically what you're going to sell as well. Okay. But it's a threshold. Okay. The other thing is, once you start amassing assets, okay, so like myself, okay, when I was a 20-something and didn't have anything, dude, you should just go for broke.
Yeah.
Okay. But as you start buying more businesses and start adding more assets, and you have real estate and you have money, what the banks want to do is they want to cross collateralize. And do you know what that means? That means, well, I'll explain it for everybody else.
Yeah.
Basically, what it means is they want collateral in your other businesses for the business loan that they're giving you to buy this business. And I don't really want to do that if I can avoid it. Okay. The other thing is the other thing that always scares me about banks is they have a law. They not only have lawyers and large contracts, but they're ready to go to war if there's ever a non-payment. Okay. So let me give you a little insider tip, and you didn't hear it from me. Okay. Because I really don't like this stuff getting out.
Hey, you heard, guys. You didn't hear him from Josh.
Okay. Seller, when you do something like seller finance or something like that, it takes money to sue somebody. Okay. When you get money from a bank, they're going to sue you. You see what I'm saying? That they're not going to go back and go, they haven't like recalculated, oh my God, it's going to cost me 15 grand to sue them. They're just going to sue you. They're already prepared for war. Does that make sense?
Yeah.
So just keep that in mind. Now, banks have the lowest interest rates. Okay. And they have other things like that. So I'm not trying to say, but for me, one of the things and I'm going to go to is I model for banks. I always put in, and the interesting thing, is that each one of the people I'm going to talk about, they all want the information a little bit different. Okay. So in bank, we talk about the debt service coverage ratio. Okay.
Right.
That's pretty much what they're looking for. And you guys know that. And V and Ansi and all those people are pretty on top of that. Okay. But what I do is I model for owner financing, which is my ideal for financing. Okay. And you'll see why, right? Because when I do owner financing, the owner may ask about my experience, but if he likes me, maybe he's willing to give me a shot.
And Josh, real quick, I want to touch on, because there's a lot of people that say, oh, if you get a majority of the portion owner finance, could mean the business is in distress, or it's just a bad deal overall. You know, they don't. But I say is they don't know how to pitch it. They don't know how to present it to the seller where it makes sense for both parties involved. So you tell us from your experience.
Yeah, no, that's 100%. And the next slide here, I'm gonna touch on that for sure. Okay. But the owner financing thing, just remember, you have a better chance getting over these things. The contract, the owner finance may not be as in depth as a bank finance contract. They may not make you my crossroads. He may not care about your experience. He may not really care about your credit. He may not even look. Okay. It's possible. Okay. Yeah. I'm not trying to say that you're doing it. The second thing I do is I model to investors. Okay. I would much rather have an investor invest in my business than go get a loan. Right. Yeah. If the business fails, that's what investors do. Okay. I mean, you're not losing people's money, but there's a lot difference on the line when you sign this personal guarantee bank loan versus when you're going to investors. Well, again, let's look down here. Okay. Banks, debt service ratio, coverage ratio. That's what they want to see. Okay. Owner finance. They want to know your down payment, future payments, interest rate. They want to know how they got faith in you, faith in the business, and faith in person. And you can push back on that. Be like, hey, you don't finance me. Are you giving me a business you don't trust? Is there a reason why you're trying to run out of time? Now, I'm not trying to say that's what you would say at first. But if negotiations get to the point where you need to push that level, you can add those things. Okay. Investors, they're looking for internal rate of return, net present value, return on invested capital. Okay. They're looking for what are their future dividends going to be. They're going to look at their preferred return, waterfall structure, and management fees. Okay. And so I model like for all three of these guys because what I want to have access to all three. My preference is to have these two, and this is a last resort backup. Okay.
That's your bread and butter, owner financing and investors.
Because when you own 10 businesses, okay, the banks are not gonna keep lending you money. Okay, they're gonna see increased risk. Okay, so which means you got to get money another way.
Real quick, Josh, what would you take as majority, the owner finance or the investor finance?
Well, that's an interesting question. Ideally, I like to have both. Okay, investors are very nice to deal with, but they're very professional, and you have to pay them, or you're going to be out of the game fast. Okay, you have to draw investor money. You got to be a professional. Okay, you have to be a pro. You essentially at this point have a private equity fund. I mean, at this point, when you're investors, you got a hedge fund. Okay, and that's what all of us really should be trying to get to. Okay, it's what I've been trying to get. Everybody's trying to get to here. Okay, but owner financing is a lot easier than getting investors.
Okay,
a whole lot easier than getting investors. Okay, so is investors superior? Yeah, I'd say investors on an apples to apples basis is superior, but it's not because owner financing is a lot easier to get than investors.
So we'd say, if you can, strive for as much owner finance as possible, right?
Well, let me show you something right here. I'm going to show you. I'm going to blow their mind a little bit.
Let's do it.
But
financial wizard, guys. Financial wizard, Josh. Let's go, Josh.
All right. So I've got some highlighted things here that I want you to pay attention to. Okay. The first thing I'm going to show you here, I want you to look at here is this earnings generated by the business. Now, in this model, I happen to use seller's discretionary cash flow. Hey, this is our numerator, right? Our numerator. So I did all the back work to get this numerator. Okay. Now I want you to look right down here. Okay. This is buyer's required annual rate of return. Okay. So after I went through my analytical model there, I popped out a rate of return that I need to invest in this business at 34.91%. Okay. So guess what? I've got two pieces to the model, right? Okay. So remember, so what let me make sure you guys understand what this is saying. This is saying that I'm going to make a 34% return investing in this business. Okay. Let's just jump back to our old return. Now, if the stock market gets 8 to 12, where's my 34% return? It's pretty up here, right? Does that make sense, V?
Yeah, it's all the way up there. Correct.
So all
And
the way
look,
up there, right?
share with them that no matter the purchase price of the business, you're still maintaining your return. You know, because that was the fascinating part for me.
Yeah, I'm going to do that one next. But here we go. Okay, so notice this: 100% down payment.
Yeah.
I'm going to value this business at $3.1 million. Okay, I'm just giving everybody a chance to look at it. I'm just going to review it real quick because I'm going to go there. Cash flow, risk rate, offering price, total compensation to the seller. It gets $3 million. There's no interest or anything, so it's 3.1. Okay.
Right.
So now we're going to go to the next part of the model. Okay. Now, when I'm doing an all cash offer, my risk goes up, right? And I really don't want to do an all cash offer. Okay. I want to be able to spread my eggs out as much as I can to multiple businesses. Okay. So inside my model, let's look at this. Cash flow stays exactly the same.
Yeah.
Rate of return stays exactly the same. Okay. 100% down payment. What I changed in my model was I put a target of an extra $100,000. So what is this telling me? It's telling me I'm going to get my return of 34.99%, plus I'm going to get an extra $100,000 in my pocket for doing an all cash deal. Now you'll notice in my model, the way I have a little conditional format here where it turns green. And I know that this deal favors me if I'm the buyer. Okay, so I do the same thing when I'm working on the sell side. Is that I push these numbers in here and I go and I back into whatever rate they're doing and see who it does. Now, V, let me, because I know you want to see it. Let's see what happens when this changes. Okay.
Yeah.
So what's happening here? Okay. I changed my model to 50% down payment.
Mm-hmm.
Okay. So everybody can see the cash flow did not change.
Yeah.
Okay. This cash flow did not change. My rate of return did not change. I'm making 34.91% on my money. Okay. However, I'm only giving a 50% down payment. Now look what just happened. Now the business is valued at $3.7 million.
Right.
That's not all. Mm-hmm. Okay, because when I'm going in to sell this to the seller, okay, is I'm saying you're also going to get an extra at this rate, 7% for 60 months. You're going to get an extra $351,000. So a total sale price of $4 million. Okay.
Right.
So let's flip that back. Okay. I'm going to tell the seller, I'll give you 2.8 in all cash. If you do 50% through the magic of all my finance training and voodoo, is I recalculate it back out, and I can go into the owner and I'm gonna say, I want to buy your business for 3.6, which is almost $1 million more.
Right.
Okay. Could you do a lot with $1 million there, V?
Oh, absolutely.
If you can't find $1 million to do something with it, then let me know. You can buy a vacation house, a trust fund for the kids.
You can move to Costa Rica, just retire there on $1 million. It's done.
You can buy yourself exactly. Okay, you can do all this for the money. Okay, and then you add this little cherry on top of all the interest. Okay,
right.
So this is the only way that I know when I'm going into owner finance and I ask for owner finance, I actually have some real bait. Okay, so because most people, what they'll do, they'll go, okay, you may have an advisor or something. They go, oh, I think the business is worth 3.1 million. And then they're going to say, well, how much are you going to get owner finance for this amount? Right. And they're going to say, oh, well, 5 or 10%. That doesn't help me.
Yeah.
Okay. 5% down is nothing.
It's nothing.
Okay. But that's the only thing they're going to say. But when you can go in and manipulate the numbers to change the value of the business, so we're essentially lowering the WACC. Okay. And there's a lot of finance going on. But what I want you to do is see on the high level. Now, V, let's have some fun.
Okay, let's go.
Now, let's have some fun. Okay. So now I'm going to change all the thing I changed tomorrow. Let's see again. Cash flow is the same. Rate of return is the same. I'm making on this business when I invest in 34.91%.
Right.
Okay. What's changed here? I'm making a 10% down payment. And just for fun, I put 10% interest and 120 months. So that's 10% for 10 years.
Yeah.
But look at the number now.
Went up to $6.1 million. Yeah.
Okay. Now, plus, let's talk about this little extra
The
cherry.
interest earned. Wow. Almost about 10 million. What
Almost,
more can you do with like 5 million more than before? 4 or 5 million?
Could you find basically this guy is basically getting them. So
you know what you did there, Josh? You essentially gave him a new life. That's what you did.
Well, let's look back at it. Right? If I do all cash offer, well, let's say if I do fair value,
Yeah.
if I do fair value, 3.1 million.
Correct.
I'm gonna push him down, negotiate him a little bit to 2.8. Okay. They go, all right. If I do 50%, he gets 4 million. If he does 10% down, $9.4 million. You've never seen that before, and I know it's crazy.
It just turned 3.1 into 9.4. So you tell me, guys, if that's not a deal, you got to go back to school.
So it goes back to here. My ideal financing is owner financing.
Right.
I got to have a way of giving some honey to the owner to give me some money. Now,
essentially, that's incentive, right?
It's the incentive to get the deal owner financed.
Another thing, real quick, Josh, I want to talk about is, and this is a very important point to leverage in regards to negotiation, is talk about the capital gain taxes. If they take a lump sum, it's about 40% that they're losing off top. So if you could seller finance more over a period of years, that down portion will be less tax, and the money they're going to get with the seller finance on the interest accumulated will compensate for that loss in tax. Essentially, they're getting almost all their money and more.
And you know what's funny is that, and I'm glad that you brought that up. Yeah. Sometimes that's the only thing that these guys are able to offer, and that sucks. I mean, yeah, that's a nice bonus, right? Does that make sense?
Mm-hmm.
But when you add that on top of this, it really becomes a powerful weapon. So I'm glad you brought that up. Now let me jump to, because Vino,
this is the magic sheet, guys.
And this is so basic, but it's so funny that everybody's so confused on this. Okay?
Yeah.
I want you to first go down and look at this little highlight down here.
Total assets.
Total assets is 3.7 million. Okay, we're going to drop back here real quick, and we're going to assume this 50% down payment. Okay, it's 3.7 million. That's where the number comes from.
Okay.
Okay. All right. Now, when I valued this company, I valued it including all the assets. Okay. So we notice here that I've got cash, receivables, inventory, deposits, equipment. I have real estate moved over. Okay. Because you should never include the real estate in your business valuation. Just do it separately.
Correct.
Okay. Okay. And he's got a car here that's not worth a whole lot, but maybe it's a company old vehicle or something. Okay.
Right.
So here are the total assets. Okay. Now you're on the phone with a broker or seller or whoever it is, and they go, and you're reading the memorandum. This business doesn't come with cash or receivables or inventory. You got to pay for that separately. Okay.
Yeah.
I go, no problem, sir. Guess what I'm going to do? We flip over to the next page, and I move the cash over to the left side, the accounts receivable on the left side, the inventory on the left side. But guess what my new price of the business that I want to pay for is?
Right.
3.3 million.
Yeah.
Now you want to spend, here's the thing, you're going to spend all this time jockeying over these accounts. Oh, the business doesn't come with inventory, or No, the cash on hand. I've been a business broker for 40 years. I was an investment banker. We sell businesses cash free, debt free. That's the way it is. Okay.
Yeah.
Well, that's fine. Okay. But I just move it over so my valuation changes. And I usually, when I'm talking to the seller, I usually am saying, hey, how do you want to do the deal? What do you want to keep? He says, I want to keep that $100,000 in my account.
Deduct.
I go, wow, I just say deduct $100,000. Here's a secret. I'm letting you guys in because I know it's a huge confusion and it confused me for many years. Every single deal is unique and you can set it up any way you want. And this is why I'm going to jump to this next page. Here's a little bit. So there's a company called Biz Equity out there. And God bless them.
Yeah.
You put some numbers in there and it's going to spit you out. It's going to spit something out. So we see here the enterprise value is 16.9. So what does that mean to you? It's almost irrelevant, right?
Right.
Now this may be good. Now most business appraisers, they're doing it for tax or estate or divorce. Okay, maybe you have a wife couple and they've got to come up with the value of the business. They can split assets, etc. The average business has. Remember when I started? The average business has 3,000 to 2,000 different prices. So not only does our financing change the price, but our deal structure can change the price.
Real quick, Josh, real quick. Saad Mohammed, he wants to know a little about your Buru. He asked, how is the internal rate of return still maintained with $10 million debt?
Okay, well, we measure the internal rate return differently. Okay, and I'll show you the internal rate of return when I get a little bit towards the end. Okay. I still got to go over a couple of different things. Okay, so I will get to that, right?
Guys, I know how you should also email Josh. Like make a custom letter, handwrite it, email him. Thank you for this time, for this knowledge, this stuff you pay for, and most won't even give it to you.
You're right, and again, I'll be available. We can do a question and answer as soon as I'm done with the presentation. But I want to get through it all so everybody can. Let's
keep going, Josh. Yeah.
Okay. All right, so let's jump into. Remember what I talked about, the banker's metric. Okay, so we're going to get into those. So you guys are following along right. Okay, so the bank metrics. This is how I normally set them up. Okay, because the banks, they look at EBITDA. Sometimes they want to look at EBITDA minus CapEx. They want to know the principal amount. Okay, so all I'm doing in a deal is I'm showing all of it. Okay, the real big difference is if they're taking CapEx out or not. Okay, and I know we touched on this, but remember, banks are more concerned about cash flow than anything else. They're concerned about cash flow just like the investors are worried about cash flow. So what I'm trying to show them is the metrics that they use, and I show them my debt service coverage with CapEx and without CapEx. Okay, so simply it's just EBITDA, because this is the way they like to see it. They look at EBITDA, they want to minus CapEx, and then we look at the loan that they're going to do, and then we show them that service coverage ratio. Okay, you guys, there's a lot of stuff on this that you guys can see. Okay, let's talk about the investor rate of return. Okay, so this is essentially a 3-tiered waterfall. Okay, and the way we calculate IRR is basically your negative out cash flow and then your positive essential inflow. Okay, the Gordon growth model is essentially a truncated discounted cash flow. The reason why I don't have people start on discounted cash flow is because if you don't know what you're doing, you're going to make large errors. And those large errors are going to cause your valuations to go whack. And it's just like the girl I was talking about in Central America. Okay, she used a discounted cash flow, and instead of using the Gordon growth model, okay, discounted, of course, I don't have a slide for that, but you go in, all traditional analysts use DCF, which is the same thing as the Gordon growth model. Okay, they just want to be able to change the different growth rates and different assumptions, which is fine, but you need to know what you're doing. Because if you don't understand the Gordon growth model, which is the basics here, you'll never understand discounted cash flow. You don't need discounted cash flow. I don't ever need it unless I'm dealing with a company that's like brand new, it's a startup, something's real funky, then I use a DCF. We're essentially buying businesses that are cash flowing and probably been around a little while. They don't need it. Okay. And again, the problem with the discounted cash flow is it's fraught with errors. Okay. But basically, what you're trying to do is you're trying to show them that internal rate of return. Because again, that's what a family office, private equity firm, that's what they're using as their basis. Now, one of the tip that I'm going to give you and save you guys a lot of, if you're trying to get investors, make sure you show the investors how much money you're going to be making as a sponsor. Okay. You mean all the time where somebody, I'll get, the private equity funds that I work for, they get sent by some investor and he just shows how much he's just showing how much the investors are getting. No, they want to know the whole cat. They don't mind paying you more because they know you're going to do the work. But my suggestion always is don't make them come after because they're going to think you're hiding something and your investment thesis is going to get put in the trash. Okay. Because if I don't see what you're making and I can compare it to what I'm making, then it's useless to me. Okay. So let me jump into comparables because I know some people probably have seen some stuff on this and it actually is something that you should be exposed to because there's really not anything out there that talks about this. Okay. So their databases have private business sales. It sounds like a really good thing, right? In real estate, we have really great comps, right? So if you go on the MLS, you can find your comps, right? You go on Zillow, they've got all these things out there that show you how much. I can go and look up how much your house is, and you can look up how much my house is. Okay,
Right.
you have comps everywhere. Businesses do not. Okay, and that's the advantage of being able to calculate these discounted cash flows. Because the problem is that I don't have to worry really about somebody going into some database, grabbing some numbers out, and thinks that he can compete with my analysis of actually going through the numbers. Real estate, they don't even, selling residential real estate and things like that, they don't even look at the cash flow. They're just looking at the comps. They're like, well, okay, this company has the same amount of bedrooms, or business has the same amount of bedrooms. Well, it must be worth the same price. Okay, so let's take a look at some of the data. Now, I know it's a little hard to see, but I wanted you to see it from the big point of view so you can see how the data is laid out. Okay, so let me zoom in here. Okay, so right here, I'm trying to find, disaster rehab companies. Okay, well, we've got their revenue here. All right, and we see one that's 4 million. That looks like the big boy. And then revenues, million, a little bit closer up, and we see what's going on there. Okay, STD, sales discretionary earnings. Okay, somebody put this in the database there. Inventory, it looks like it's not an inventory business because they're essentially reporting no inventory. Furnished fixtures and equipment. Okay, here's super interesting. This company right here produces $1.2 million, and they have $275,000 in furniture and fixtures and equipment.
Yeah.
But this company here produces $1.4 million revenue and only has $50,000 in furniture and equipment. Do you know why that is? What possibly it is?
What is that?
That this company is leasing their equipment, and this company owns their equipment.
Makes sense.
Okay,
yeah.
So you have to pick up things in the numbers. Okay, let's look at the rents. Okay, the rents are all well. This one is definitely they must have owned the real estate because that's just an outlier, right? But 4%. So you got some data here, employees. Let's go to the next page. Look at the transaction. Okay, we got asking price, closing price, price to revenue, price to SCD, the down payment, the terms. This is good knowledge. Okay, this is good to know, right? When we're negotiating. But over the past, and this is recent. I literally took this, the other day. We only have in this database, I think these first two aren't even things. You're only talking about 8 different companies, and we don't have anything that's recent. Is today's economic environment the same as 2015? I don't know. You have to make that assessment as the analyst, okay? So like I said, you know how I use these? How do I use these values? If these help me justify in my offering price or my selling price, so if I'm making a sales memorandum for a business I am selling for a client, and my intrinsic value pops up somewhere in here, do you think I'm going to include these? Heck yeah, right? I mean, why not, right? But the problem is if you're using this as your sole sole place of how you're coming up with the value of the business doesn't tell you anything about the cash flow. And again, this data is really shoddy because let me show you what happens next.
Yeah.
Do you see all the locations of the business?
Right.
Do you see the
Majority are in Florida.
So is that relevant if you have a disaster relief company in New Hampshire? I don't know. You see what I'm saying? That's why using these data points, yeah, it's okay. At least you're getting something. Okay, you're getting some data, and if it helps you out, okay. But if I was selling or buying a company, a disaster rehab company in Florida, then this is a really good thing to use. That makes sense, right? But if I'm in freaking Minnesota or Vermont, I don't know if this makes sense.
Correct.
Okay? So that's the problem with these comp databases, and that's why we don't do it. So let's talk about quickly at the end. I think I proved to you by now that the rule of thumb is pretty much not really worth anything because the deal changes based on the deal structure and the financing. Okay. So again, when somebody's talking to me on the phone and they're talking in their language, they could have done this for 15, 30, 40 years and they just see things only one way. That's fine. But I definitely want to know that, again, it basically comes down to what is the cash flow we talking about, what cash flow, and what risk rate's being used. Okay. I've seen hundreds of prices on acquisition, just like I showed you. Okay.
Yeah.
And so my thing is, if you're using the rule of thumbs to make your acquisition, that's a fool's game. Okay. Because you can get shellacked with negative cash flow when the whole time you thought that you were buying a good business. And again, this is my my little spiel is don't use rule of thumbs. You can use them as a quick metric and read about how a broker may be doing a business, but don't do it when you're putting money or your client's money at risk. Okay. Right. And then just quickly, obviously, here's my email, some of my qualification, and I do deferred fees and equity splits if you're interested. I obviously am super busy with my businesses and doing a lot of private equity, but definitely let me know if I can be of ever help. Now, I will open up the forum basically for questions, and you just want to read them off to me, V?
Yeah, of course. So real quick, guys, just want to tell you, make sure to thank Josh. Email him and tell him thank you for the information he provided in this video. Great to have you, Josh. Appreciate your time. As you can see, this guy not only has all these degrees, but has the real world experience of buying and selling businesses and so on. So thank him. So let me run through a couple questions I got, Josh. Okay. So Chrome said, what is a healthy gross profit margin for SMEs? 40%? Question mark.
So the problem is, okay, let me tell you what's healthy and what's not healthy, okay?
Right.
It depends. It goes back to what you've calculated, okay? Because once you've redone the income statement, okay? For example, you've done all your proper add backs, okay? And you've subtracted an owner's salary, you've made the rent adjustment. And again, if you guys are interested in stuff, I can do more classes here and just tell me what topics. And for example, if you want to talk more about add backs and stuff, we can spend a whole session on it. But so what happens is once you get all the cash back, it depends on the industry. Okay, because here's where it's going to break down, and sometimes where the industry plays a role. Okay, if you have a business that doesn't have a lot of assets, okay, it's usually going to produce a higher profit margin, which is a good thing. Right. But having assets on your balance sheet makes your business less risky because you have solid assets. If you go bankrupt and the cash flow is you can liquidate all these hard assets. Yeah. Okay. And you're going to get financing at a much cheaper rate. So this company here, let's just say, for example, this company here company A has no hard assets. Okay. Yeah. Getting a loan for this company is going to be freaking hard. Okay. Whereas this company, they may have a lower profit margin and you're trying to do an LBO. Well, they have lots of assets that you can get a loan off of. because think about this: do you want to make an unsecured? You're the banker. Do you want to make an unsecured loan or a secure loan? I want to make a secure loan, which means it's going to bring down my interest rate, which allows me to get into the business and then start to produce higher profit margins as they go along.
Right.
Again, this is the reason why I want to exercise. This profit margin can be manipulated. So you've got to do the exercise of doing all the add backs, okay, looking at making at how the owners are getting paid. You got to do all that. Then you can access of a good profit margin. Some of the old school rules of thumb, and again, I hate rules of thumb.
Yeah.
But they used to say anything less than 10% adjusted thing, you're going to have a tough business. It's not as free of cash, but it could have a lot of assets, which is also so. If you're looking at a business that doesn't have a lot of assets and it's producing, and after doing the adjustments, makes less than 10% return, then you need to be careful with that business. Okay.
Right.
If the business is making 10% to 15%, that's very healthy. Okay. That's usually once you actually really take all the adjustment outs, that's probably where most companies are. If you're making 15 plus, usually, unless you have some type of market advantage, the economics, the competitors are going to come in and defeat your thing. So that's what they usually do. So if you have 15 plus, you have a super business. 10 plus, you have a great business. And then anything less than that, you need your okay business and you need to make some improvements. So hopefully that helps.
Great to hear. So real quick, Josh, remember the call we had with Bill, the accountant?
Yes.
And he was talking about essentially, these things are more of a do not try at home unless you have the experience, you have the knowledge. How can we explain this to the accounting firms that will be working with us? Or let's say we have an accountant or a financial director. How can we make a simple explanation of, hey, look for this so we know what's the true cash flow?
Well, here's the problem is that most, and I don't mean to be offensive to anybody. Okay?
No, of course.
But most CPAs, their job is they do taxes. Okay. So they're not finance guys and are looking at this type of material. Okay.
Yeah.
The other problem is that sometimes when you're dealing with higher level accounts, like, 'cause I know Dan Pena is always like, hey, you need some big four accounting firm guy to give you some muscle behind the numbers. Here's the only caveat to that. Those big guys only know how to do it one way under their corporate philosophy. Okay. Because when you work in corporate, you may be a highly paid soldier, but you're a soldier. Okay. And the way you're taught to value and put numbers together is the way you know it. And sometimes they assume that that's the only way. And I am fortunate to have the experience where I've been up and down the chain to where I'm always like, hey, they really don't know it. So you have to ask them. I mean, when you're looking to hire these guys, you need to ask them how they calculate free cash flow. Okay. And then talk to them, because you want to be looking at a sheet like this and go, okay, which cash flows do you use when you're using and you're looking at a thing? He may say, hey, I use the cash from operations. Okay. And so there's some high level kind of finance tricks, for example, where you're not taking tax out, but you're gonna change the risk rate. Okay. And they may do it like that, and that may be in technically that is well in the theory realm of what we use. But the problem is that unfortunately you're not going to have a lot of guys who understand this, and that's essentially why I'm highly paid and highly sought after, because I know how to calculate, right? So you got to test these guys, and like I said, depending on how much money's in line, you may not want to be the first guinea pig.
Right. Okay, so Chrome said, I heard some investors are looking for 2 times or more amount return if it's a loan compared to if you offer an equity percentage share in a company. Wondering if you've run across that.
Oh, absolutely, my friend. Okay, so it goes back to, let's look at this risk rate. Okay. And you have to remember, when you're dealing with investors, we're alternative. Okay. We are not protected equity. Okay. This is where we're living at. We're living out here. Okay. A professional portfolio manager would tell them that they should probably put anywhere from 5 to 10% of their net worth in this alternative. Okay.
Yeah.
So the portfolio theory would you would want to put 90% all down here, and you're going to put 10% out here. Okay. So when you're offering investors, no matter how you do the crumble, okay, they're going to look at what's the collateral, what happens if they don't pay me back, all those things go into detail. So an investor is going to say, for example, let's say you come to me and I'm an investor on the loan.
Yeah.
I'm going to say, what's the collateral? Okay, so if you don't pay me, can I take over the business the next day?
Right.
You miss one payment, all of a sudden I become the majority shareholder. Well, that lowers my risk, therefore a lower rate of return. Okay, whereas you say, well, if I default, you default on me, you get a 3-month grace period, and you can pay me back over 3 months, and you have more time to think. Well, that's higher risk to me, which I get at a higher rate of return. Okay,
Correct.
So you have to think about it clearly. Real estate lenders are somewhere between 12 to 20%. Okay.
Yeah.
Real estate is a lot safer than business. So if your return that you're offering to your investors is not beating that, you're not gonna okay, let me say this. Let me just caveat. You may be able to fool some people, but you're not going to be able to fool professional investors. They have lost enough money in their lifetime to know what they're doing and to know if your deals are done.
Right.
So again, 2 times earning just depends what the collateral is. And I'm sorry to be opening, but if you're saying, hey, I can make 100% return, if that's what you're saying 2 times, okay, then that's a high return that they're looking for. Yeah, you should be able to attract investment at that higher rate. Does that make sense?
Yeah.
So I'm going to invest $100,000 with you, and you're going to tell me in a year you're going to bring me back not only my 100,000 but another 100,000. Okay, if that's what we're talking about, yeah, you're up here. Yeah, you're going to attract funny business. If you're offering a 15% return, and I'm taking a lot of risks, you're not going to get as much traction because your equity firm is not built up the track record. Now, if you're Ray Dalio or you've been a private equity wizard, or you're like Mr. Smith at, or you're KKR or some other huge private equity group, yeah, your risk's going to come down and they can get their money down here.
Right.
You, Mr. starting out guy, you're going to be up in this range here.
Correct. Okay. Saad Mohammed asks, how can the seller save taxes? No, how can seller finance save taxes, and which one? I want to know how to convince the seller as compared to down payment.
Well, you saw what I did. I just offer them that high rate of return. Right?
That's it. Money talks. Bullshit walk.
Because Jordan on the line can tell you that he's seen me do offers where I've literally come in with 2 offers, 2.8 million and 6.1, total 9.4.
Hey, you heard, guys. That's how you do it.
Now, he's going to go back. I really want his wife to see this number.
Yes.
Okay. Because he may say, well, honey, I just want to take 2.8 million and I am such a good investor. I'm going to go out and invest in all these different hedge funds and we're going to make all this money. Whereas the wife goes, honey, I can find a lot to do with $5 million.
Okay? There you go. How do you convince the seller? Well, you tell him if you were to take everything up front, 2 million. If you seller finance, 9.
If you can't convince him with that, then I'm sorry.
Skip.
You have no hope.
Quit. Just quit. Okay.
Yes. You need to learn how to model. Okay, and let somebody else do your sales. Is that a fair statement?
Just find the deal flow, bring a negotiator. Okay, hear me. Chrome asks, what percentage of long-term debt is acceptable for a SME? I heard of they can pay off the LT debt, the long-term debt in 4 years or less from their earnings. Is the company in decent shape? True. So he's talking about like how much debt is acceptable for a SME, and if they're able to pay it off earlier, is that good?
Absolutely. So when we model